I created this video on the basis of a query from Vishwadip Aditya as to why interest is calculated on average balance and not on outstanding. Interest calculated on average and not on outstanding. First of all, let me clarify here. Interest will always be calculated on outstanding only. Calculating interest on average arises only in case of estimates. That is, when you are putting up a loan proposal and when you want to calculate what will be the interest on the loan they'll be drawing. Okay, so instead of doing that entire 8 years, 10 years monthly calculation and arriving at rate of interest, you can go with average interest, and that will give you approximation. You may not get the accurate monthly interest servicing, but in CMA for decision making and all, what they look at is the gross data, and that's why average is calculated. Let me show the scenario also. So he gave me a scenario where the opening balance was 10 lakhs, closing balance is 8 lakhs. It means there is a repayment of 2 lakhs and interest rate is 10%. So the question is, what is the interest estimated to be payable? Okay, what is the interest payable? And I gave the reply, opening balance is 10 and there is a repayment of 2, and so closing balance is 10 minus 2, and we can arrive at average balance. Average balance is nothing but opening balance plus closing balance divided by 2, and on this interest at the rate of 10% can be applied. That is 9 into 10%. So interest works out to 0.9 lakhs. Okay, 9 lakhs or 9 crore, whatever. So here, this alone I'll change this percentage. Okay. Now the question is, why we are not calculating exact interest on outstanding, why we are going on average? See, it's all basically for decision making, it's not for charging. Okay. Let me show you what will be the interest if we go and apply this rule on monthly interest, and let's see whether that monthly interest calculation and this average is approximating or not. Okay, so how many months? Let's say this is 1 year position, so 12 months, 1 2 3 4 5 6 7 8 9 10 11 12. I'm sorry. Yeah, and the opening balance, I'll put the opening balance here. Opening balance was 10. Repayment every month. See, we have seen there is a total repayment of 2 lakhs. Okay, that's over a period of 12 months, right? So I'll put 2 divided by 12. So this is the repayment. I'll just round it off to 3 digits. It means there is basically a repayment of 16,666 something. Okay, and interest have to be calculated. Interest will be calculated on this opening balance only. So on this 10% interest will be calculated for a period of how many months? 1 month. So we'll divide it by 12. So this will be the interest position. So what we get is 0.083. And what will be the closing balance here? Closing balance is opening balance minus repayment. This will be the closing balance. And this becomes opening balance for the next month. Okay, and interest will come to interest, but before that, what's going to be the repayment? Repayment already we have arrived at. It is 2 lakh divided by 12. Okay, so for 12 months I'll put this, because if you add all this you should get 2. Okay, add all this. Yes, here you can see 2. Okay, or I'll put the total here. Yeah, it's 2. Now from this 9.833, interest have to be calculated, and I'll just copy this formula. That is 9.833 into 10% divided by 12. It is 0.082, and closing balance will be 9.833 minus 0.167. Okay, so you get 9.667. So the formula is applied. So let me drag the formula for 12 months. Let me drag it fully. Okay. So this is the interest calculated on a monthly basis. I am totaling it here. See, when I total all this, what I am getting? Let me see the total. It is 0.908, and the interest what we have calculated on the basis of average is 0.90. So they are more or less close. I mean, it cannot be accurate, but it is approximate, because in the beginning itself I said calculating interest on average will give you approximate figure, and this is basically for decision making purpose, for estimates. Okay, but what you are going to charge actually on the borrower will be always based on outstanding and not based on average. I hope this calculation makes it clear that if it is going to be like monthly payment, and if you are going to arrive at if you are going to arrive at interest based on average balance, there will be more or less close, but they cannot be accurate. There will be some approximation difference be there always. Are you struggling in understanding banking credit related matters like financial ratio analysis, cash flow and fund flow analysis, working capital assessment, and products like cash credit, letter of credit, bank guarantee, buyer's credit, term loan appraisal covering debt equity analysis, DSCR, FOIA? Are you a finance professional working on project funding for your clients? Are you finding it difficult to write down a comprehensive loan proposal? Are you a banker aspiring to rise to top in your career? Then this course is for you, Banking Credit Analysis Process.